In this video, we are going to talk about what is the PE ratio in stock market. So before starting this video, please like this video and subscribe to our channel for future updates. The price to earnings ratio, PE ratio, is the ratio for valuing a company that measures its current share price relative to its earnings per share, EPS. The price to earnings ratio is also sometimes known as the price multiple or the earnings multiple. PE ratios are utilized by financial backers and experts to decide the overall worth of an organization's portions in logical correlation. It can likewise be utilized to analyze an organization against its own authentic record or to look at total business sectors against each other or after some time. PE might be assessed on a following, in reverse-looking or forward, anticipated, premise. Here's a description of what is the PE ratio in the stock market. Let's start. PE ratio formula and calculation. To decide the PE esteem, one must essentially isolate the ongoing stock cost by the income per share, EPS. The ongoing stock value, P, can be found essentially by connecting a stock's ticker image to any back site, and albeit this substantial worth reflects what financial backers should at present compensation for a stock, the EPS is a somewhat more indistinct figure. EPS comes in two principal assortments. TTM is a Wall Street abbreviation for following a year. This number signals the organization's presentation throughout recent months. The second sort of EPS is found in an organization's income discharge, which frequently gives EPS direction. This is the organization's best ballpark estimation of what it hopes to acquire from here on out. These various variants of EPS structure the premise of following and forward PE separately. Understanding the PE ratio. The price to earning ratio, PE, is perhaps the most broadly utilized instrument by which financial backers and investigators decide a stock's relative valuation. The PE proportion assists one with deciding if a stock is exaggerated or underestimated. An organization's PE can likewise be benchmarked against different stocks in a similar industry or against a more extensive market, like the S&P 500 index. Here and there, investigators are keen on long-haul valuation drifts and think about the PE 10 or PE 30 measures, which normal the beyond 10 or recent long stretches of profit, separately. These actions are much of the time utilized while attempting to check the general worth of a stock file, like the S&P 500, on the grounds that these more drawn-out term measures can make up for changes in the business cycle. The PE ratio of the S&P 500 has vacillated from a low of around 5x in 1917 to over 120x in 2009, just before the monetary emergency. The drawn-out typical PE for the S&P 500 is around 16x, implying that the stocks that make up the list aggregately order a superior multiple times more prominent than their weighted typical income. Forward price to earnings. These two types of EPS metrics factor into the most common types of PE ratios, the forward PE and the trailing PE. A third and less common variation uses the sum of the last two actual quarters and the estimates of the next two quarters. The forward, or leading, PE uses future earnings guidance rather than trailing figures. Sometimes called estimated price to earnings, this forward-looking indicator is useful for comparing current earnings to future earnings and helps provide a clearer picture of what earnings will look like without changes and other accounting adjustments. Trailing price to earnings. The following PE depends on past execution by isolating the ongoing offer cost by the all-out EPS profit throughout the course of recent months. It's the most well-known PE metric since it's the most goal-accepting the organization's announced income precisely. A few financial backers like to take a gander at the following PE since they have little to no faith in another singular's income gauges. In any case, the following PE additionally has its portion of weaknesses. Specifically, an organization's previous presentation doesn't flag future ways of behaving. Financial backers ought to, along these lines, commit cash in view of future income power, not the past. The way that the EPS number remaining parts consistent, while the stock costs vary, is likewise an issue. Assuming a significant organization occasion drives the stock cost fundamentally sequential, the following PE will be less intelligent of those changes. Valuation from PE. The price to earning ratio or PE is one of the most broadly utilized stock examination devices by which financial backers and investigators decide stock valuation. As well as showing whether an organization's stock cost is exaggerated or underestimated, the PE can uncover how a stock's valuation analyzes to its industry bunch or a benchmark like the S&P 500 index. Generally, the cost-to-profit proportion demonstrates the dollar sum a financial backer can hope to put resources into an organization to get $1 of that organization's income. To this end, the PE is here and there alluded to as the value numerous in light of the fact that it shows how much financial backers will pay per dollar of income. Assuming an organization was as of now exchanging at a PE different of 20x, the translation is that a financial backer will pay $20 for $1 of current income. Example of the PE ratio. As a historical example, let's calculate the PE ratio for Walmart Incorporated, WMT, as of February 3, 2021, when the company's stock price closed at $139.55. The company's earnings per share for the fiscal year ending January 31, 2021, was $4.75, according to the Wall Street Journal. Point 3. Therefore, Walmart's PE ratio is $139.55. $4.75 equals 29.38. What do you think of our video? Let me know in the comments section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.